Welcome to Sophie Daddy's channel. You know, for decades, investors have been searching for the holy grail, a portfolio that can make money no matter what the economy throws at it. And Ray Dalio's legendary all-weather strategy? Well, that was supposed to be the answer. But after a really brutal couple of years that just shattered all the old rules, there's this huge question hanging in the air. Has the all-weather strategy finally met its match?
So let's dive right in. Before we can even talk about the all-weather strategy, we first have to talk about what most people think of as a safe portfolio. I'm talking about the classic 60-40. 60% stocks, 40% bonds. You've heard it a million times. It's called balanced. But what if I told you that balance is actually a dangerous illusion, one that's hiding a massive, concentrated risk?
And this right here, this is the hidden flaw. See, you might have split your money 60-40, but you absolutely have not split your risk. Because stocks are just so much more volatile than bonds, about 3 times more actually, that 60% of your capital is driving something like 90% of your portfolio's ups and downs. The takeaway is pretty stark. Your balanced portfolio isn't really balanced at all. It's basically just a stock portfolio in disguise, and its fate is almost entirely tied to what the stock market does.
Okay, so you're probably wondering, is there a better way? Well, we are going to break it all down. We've just seen the big flaw in the 60-40. Next up, we'll explore the whole philosophy behind the all-weather strategy, really get into its mechanics, look at its track record, and then, this is the big one, we're going to stress test it against that crazy storm of 2022 to get to our final verdict.
This brings us to the absolute core philosophy of the all-weather strategy. And what's so interesting is that it wasn't born in some academic lab. It was actually forged in the fire of a massive trading failure. Dalio himself made this huge bet that the market would crash, and he was spectacularly wrong. It nearly wiped him out. But from that failure, he had this huge realization: the future is literally unknowable. So he set out to build a portfolio that wasn't designed to be right, but one that was designed to survive precisely when you're wrong.
And this quote just captures the whole idea perfectly. Think about it. Everything that's widely expected, good earnings, a Fed rate cut, it's already priced into the market. The events that really cause the big moves, the crashes, the huge rallies, they are always surprises. So what does that mean? It means any portfolio that's built on a single prediction of the future is incredibly fragile. The whole goal here isn't to predict, it's to be prepared for any possible future.
So, how in the world do you prepare for the unknown? Well, Dalio did something brilliant. He simplified the entire economic world into just 4 seasons. He argued that pretty much everything that moves asset prices comes down to shifts in 2 key things: economic growth and inflation. This gives you 4 possible scenarios. Growth can be higher or lower than we expect, and inflation can be higher or lower than we expect. The beauty of this strategy is to own a mix of assets so that no matter which season we find ourselves in, something in your portfolio is designed to do well.
Okay, so how do you actually build a portfolio that's balanced for these 4 seasons? This is where things get really cool and innovative. The strategy just throws out the old rulebook of balancing your dollars and introduces this revolutionary idea. You need to balance your risk. This is the engine of the all-weather portfolio, and it's called risk parity.
So what exactly is risk parity? Well, instead of asking, how many dollars should I put in stocks versus bonds, you ask a totally different question. How much risk is each one of these assets contributing to my portfolio? The whole goal is to make sure that no single economic outcome, like a recession or a spike in inflation, can totally dominate your portfolio and blow you up. You actually size your positions so the risk from your stocks is balanced by the risk from your bonds, which is balanced by the risk from your commodities, and on and on.
And this is what it looks like in the real world. Now, when you first look at this, a massive 55% in bonds seems incredibly conservative, right? Almost like you're betting on a terrible economy. But it's not a bet on the economy at all. It's a mathematical necessity. Because things like stocks and commodities are just so much more volatile. You have to hold a much larger dollar amount of less volatile bonds just to make their risk contribution equal to the others. It's all about balancing the risk exposure to each of those 4 economic seasons.
Okay, so that's the theory. It sounds good on paper, but does it actually work when markets are in a total panic? I mean, the true test of any defensive strategy is how it holds up when the world feels like it's ending. And for decades, the all-weather portfolio basically built its entire reputation by standing strong during the market's most violent storms.
I mean, look at 2008. The global financial crisis was the ultimate trial by fire. The stock market was in an absolute freefall, losing more than half its value. A typical 60-40 portfolio got hammered, down about 30%. And the all-weather portfolio? It only lost about 17%.
While stocks were completely crashing, its huge stash of long-term bonds soared as everyone fled to safety. It was the perfect cushion. And then we had 2020. The COVID crash was faster and more violent than anything we had ever seen. The S&P 500 just plunged by a third in a matter of weeks. And what happened? The all-weather strategy did its job, again. That combination of bonds and gold acted like a shock absorber, limiting the damage to just a 6% drawdown. It proved once more that it was built to handle these sudden deflationary shocks.
You know, the power of avoiding these huge losses isn't just about sleeping better at night, it's really about brutal, unforgiving math. Look at this. If your portfolio falls by 50%, you need a 100% gain just to get back to where you started, 100%. But if you only fall 15%, you just need an 18% gain to recover. By avoiding those really deep holes, your wealth can compound so much more efficiently over the long run. It's a huge deal.
So for decades, the all-weather strategy really did seem invincible. It passed every single test thrown at it. But then, 2022 happened. And this wasn't another 2008 or 2020. No, this was a completely different kind of monster. It was an inflationary storm that created a perfect, unprecedented challenge, and it struck right at the very heart of the strategy's design.
For 40 years, investors relied on one simple rule. When stocks go down, safe government bonds go up. That negative correlation was the bedrock of literally every balanced portfolio. But in 2022, as inflation ran wild, central banks had to hike interest rates at a historic pace. And that just crushed bond prices at the exact same time that fears of a recession were crushing stock prices. The unthinkable happened. They both plummeted, together.
And the all-weather portfolio was not immune. Now, to be fair, it still lost less than the stock market did, but it suffered a really significant 17% drawdown, which is about as bad as it did in 2008. This was a huge shock. The small allocation to commodities helped a little, but the storm really exposed the strategy's kryptonite, an inflationary shock where the cure, raising interest rates, is poisonous to both stocks and bonds at the same time.
So this brings us right back to our big question. After the storm of 2022, is the all-weather strategy broken? Well, the answer isn't a simple yes or no. To really get to the truth, we have to separate the rigid formula from the timeless philosophy behind it.
And here's the key distinction. On one side, you have the static formula. That specific 30-55-15 mix faces some real challenges right now. Its heavy bond allocation is a major headwind in a world with higher inflation and rising rates. But on the other side, you have the philosophy. And that philosophy, the principles of risk parity, true diversification, preparing instead of predicting, is more important today than it has ever been.
So what are the big lessons here for every single investor, whether you use this specific portfolio or not? First, true diversification isn't just about owning stocks and bonds. It's about owning things that will actually do well when your main investments don't. Second, you have to focus on how much risk each part of your portfolio is contributing. Third, just stop trying to predict what's going to happen next and start building a portfolio that can handle a bunch of different outcomes. And finally, remember that avoiding those big losses is the absolute key to staying in the game and letting compounding work its magic for you.
And for those of you who are interested in this, building a simplified version of this portfolio is actually remarkably straightforward. You can do it with just 5 common low-cost ETFs. You'd use VTI for stocks, TLT and IEI for your long and intermediate bonds, GLD for gold, and DBC for a basket of commodities. It's a super practical and actionable way to apply these powerful principles. So we'll end with a big question for you to think about. The economic environment of the last 40 years, one that was defined by constantly falling interest rates, that's over. The world has changed. So you really have to ask yourself, is your investment strategy built for the rules of that old world, or is it truly prepared for the uncertainties of the world to come?
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.